Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, here we are again.
The U.S. Fed has hiked its rates, but I've noticed the Central Bank of Europe and the Bank of England are holding steady on their current interest rates. The Bank of Canada holding steady. What's the conflicting message here, or is there one?
Well, you know, I really am not impressed by what central bankers do. While the world really gets focused on changing the administered rate at the Fed by minuscule amounts, history has shown that central bankers follow the major trends in market rates of interest and also follow them when you get a change. And one of the things that the street kind of worries about is rising short rates. But if you look through history, and you're in a business expansion, short rates, market rates of interest go up. Like market rates of interest are the key one, of course, the U.S. 3-month Treasury bill. And it's still going up. So now you're going to find, and I've seen the odd statement on this, that this is concerning. No. So long as short-dated market rates of interest are going up, the boom is on. It's when they start going down is the problem, and here again is where the consensus gets screwed up, because when the interest rates start to change, it sort of represents a strain in the credit market. And when the establishment sees the strain in the credit markets, it says, oh, well, the Fed can lower interest rates and that'll keep the stock market going. But again, we're going to insist on evidence, and the evidence is that on every business expansion, market rates, short-dated market rates of interest go up. And then in anticipation of the end of the expansion, these 3-month Treasury bills start down. And just going back to the 1860s, the biggest declines in the senior economy, in the senior central bank administered rates, have occurred in severe bear markets, cyclical ones. So the idea that the Fed or the Bank of Canada will lower interest rates when signs of trouble appear and then all will be well is absolutely without foundation. So at the moment, the U.S. T-bill rate is still going up. The other one that is part of a boom is that the low-grade stuff, junk bonds, go up in price and down in yield. Well, that action is stalled out. And then the other one on the credit markets is that the credit spreads, which is the difference between high-grade bonds and low-grade bonds, in a boom, everybody has confidence and reaches for the extra yield, and then the junk bonds get part of the party. Now, they peaked in November with fairly good technical registering with it. So what we were looking for, Jim, since early October was that on the stock market, we noted that even the Dow Jones average could become bubbled. That was October the 4th. And indeed, the performance has been very good. And with that, note that the senior indexes could go into a bubble was that we noted that when a bubble is an extreme and very intense wave of speculation, and they run until they quit. But just to put some guidance in, we noted that in the past there were some very strong speculative moves that completed in January, so to speak. So you had in 1973 an outstanding bull market in New York, concluded on January the 11th, and a long bear market followed. Then moving on to 1980 was the really outstanding speculation in gold and silver. And I just took a look at some of the numbers the other day, and we'd always known, of course, everybody who was there at the time remembers that peak for precious metals in January 1980. And so silver really moved from a downtick low in November of about 15, and the high was 48 on January 21st. So, that's like a quadruple. And the street now is all excited about Bitcoin things, and those gains have been impressive. This is the Bitcoin thing now is becoming, or has become, a really great financial event. And it's when they go straight up, you really test any kind of technical measures, and you just sort of say it just goes up until it quits. But on the stock market side, I think that maybe the guidance from even the Nikkei back when Tokyo was leading the speculation, that one peaked in the last trading day of 1989. And of course, the multi-year bear market for Tokyo followed. So when you're in such a powerful move as we have now in the stock market, it's very difficult to get out there and say, whoa, stop, and it will complete at this date. So all you can do is look for guidance, measure the excesses. Yeah, you've got, as we've been saying, at each of these rushes, the valuation for the stock market is high, has been high. And each of the rushes, like into June and then into September and then now, you've had very good high readings on the technical measures. Momentum and pattern is there. So we know that now the markets are very precarious, and in which case one's curiosity goes to what would precede the end of speculation in the stock market, and that would be, as I said, short-dated treasury bill rates turning down, credit spreads widening, which let's put it that way, spreads are no longer narrowing. And then, of course, the 3-month bill is very much part of the yield curve. And that yield, the 3-month bill is still going up in yield, and the curve is still flattening, which you get with any boom. Sometimes the curve can invert, which means that the short rate is higher than the long rate. And sometimes you can have a cyclical change in the U.S. economy without it actually getting to inversion. We're not quite inverted yet. So, Jim, it's been a fabulous party. And the industrial commodities, we figured, would be firm right through into December or so. But these in late November look like they're looked like they recorded some technical excesses. So it looks like their best could be in, and in which case what's going to happen for industrial commodities, maybe after the first quarter of next year they could roll over, and that then would be a sign that the global economy would be cooling. So we're watching some of these things, Jim, because it is absolutely fascinating action.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome back. We're chatting with Bob Hoye. Bob, what kind of value do you see in the so-called FANGs? Rick Ackerman called them just a bunch of glorified ad agencies without any real assets. What's your view on them?
I would agree with Rick on that. It's a good description. But they've been great players. You know, in 2007, there was the Fabulous Four, big, attractive stocks. And going way back to late 60s, you had the Nifty 50. That was 50 of the big stocks that were, you could buy them without worrying about anything until it was all over. So, the fascinating thing, Jim, when you're in this kind of speculation is the intensity of the convictions of those who are positioned and adding to their positions, and it places a burden on the stock analysts who see, institutions, people, they want to buy the stocks, the brokers want to do the business, so then you come out with earnings estimates that may not be realistic. But it does then, in an individual case, if you say a stock here that's doing well, earnings are going to be up 15% for next year, therefore the stock isn't as cheap as you think, or isn't as expensive as you think it is. So that then will all come out in the wash at some time. But the valuations, the one I like is the S&P relative to the average wage in the U.S. And what it means is how many hours of labor does it take to buy a unit of S&P, and it's very much higher than in the market peak in 2007. And of course the dot-com bubble in 2000 drove multiples to the moon, and it's even now higher than it reached in 2000. So by I think a reliable indicator, the stock market is very highly priced, even in this age of serial bubbles. So things as that we've been noting and talking about is the action in the industrial commodities, which likely the best is in. The action in the credit spreads, which in narrowing the best is in. And I guess it comes down to also on the yield curve, the difference between long-dated and short-dated instruments is when it changes. So then when you get these changes, how long will it be until the stock market is affected by it? And if we look back And we used these credit spreads and the curve in the early part of 2000 in the dot-com bubble. And when those reversed, it was virtually with the peak of the market, the peak of speculation in March of 2000. But in 2007, the changes in the credit markets were more or less accomplished by August, and the stock market high was, October the 12th or something like that, close to the middle of the month. So these changes in the credit markets, it looks like it's trying, but it's not dramatic. So that would be step one to get a reversal in the credit markets. Then the next one has a bit of mystery to it, is how long it takes to anticipate the contraction in the stock market.
And we'll talk about that, Bob, right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Bob Hoye. Bob, do you think we're going to get a correction in January?
Well, I wouldn't say in January, but sometime in the first quarter, yes.
Any idea how much?
I think it could be quite significant. It just depends on how much they blow their brains out between now and actually when it does peak. So, and then on the other side, you've had considerable disappointment in the precious metal sector. You know, earlier in the year, you had a pretty good rally in gold, and that, of course, got all the juices going on the gold bugs, and they were hauling out their forecast of $5,000 gold. But they're in an awkward position because they know that the Fed is extremely reckless. And when it was extremely reckless in the 70s, the dollar went down and gold went up, precious metals went up. And that's what the gold bugs learned. And what you have now is you're in a world where the speculation is in financial instruments. So you've got the huge rally in bonds, including European bonds, has been the equivalent of gold going to 10,000. And it's been against very reckless central banking, which is appropriate. But the thing that the gold bugs have to learn, maybe they're learning it now, is that central bank recklessness doesn't always drive gold prices or silver prices. Sometimes it's part of the financial speculation, which it is now, and there's nothing you can do about it except wait for the financial speculation to burn out. Now, in previous great bubbles, 1929 or 1873, or going back even as early as 1825, with the bubble, the financial bubble, the real price of gold has gone down regularly. And then once the speculation fails and you're into a credit contraction, then the real price of gold goes up for decades, such that then gold sector becomes the premier sector for making money. And somewhere ahead of us will be an outstanding cyclical bull market for the gold and silver sector, when other sectors may not be doing so well. And so you have this irony that Fed recklessness now going into financial speculation, not into gold and silver speculation, and then you have financial speculation failing and setting up the next big speculation in gold and silver. I'm looking forward to the new bull market for precious metals for when it starts. And I think we'll be quite alert to when it does start, and we can enjoy a different party. Perhaps it might come out of the first quarter, but, we'll keep you advised on that, Jim.
Thanks a lot, Bob, for chatting with us.
Good to be with you, sir.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of Howe Street Media Incorporated.